Hey warriors, hope you're all doing well. Let's start with part 2 of the amendment lectures of CA Inter May 2024 and November 2024 exams. Right? Until last class, we had done things about basics, residential status, scope of total income, and salaries and HP and PGBP. Right? We're going to move to the next part of the amendments, which is under from capital gains. But before I move forward, there's one small correction which I wanted you people to make. Let's go back to our PGBP chapter. In this PGBP chapter, you have the section called as section 43B, right? Yes. In the section 43B, there's one small change to make. The amendment of the current year, which is point number G. Last time when we discussed, the wordings would have come and said any amount payable to an MSME, right? It would have come and said any amount payable to an MSME which is not done within 45 days or 15 days as per the agreement and everything. There's a small change to it. If you read the definition of MSME, MSME sees micro, small and medium enterprises. Right now, the amendment which has come for the current year is not for all the three cases. Income tax has notified this amendment only for micro and small enterprises. Meaning, if it's a medium enterprise, then there will be no disallowance to it, even if there is a delay. There's one small change to make. I'm reading it once again for you. It says amount payable to micro and small enterprises beyond the agreed due dates, which is not exceeding 45 days or 15 days if there is no return agreement. From the date of acceptance, no disallowance will be made if the payment is made to medium enterprises. Please keep this in mind. Earlier, when ICA had released the material, they had put all MSMEs and therefore the definitions were not clear. Currently, when the RTP got released, that's when the clarification came in. They came and clarified that you will not have any disallowance relating to medium enterprises. So this is one small change to be made. Please keep that in mind. Balance everything. What we discussed is all the right answers. Yes, the examples also stand good because we did not do the definitions there. But yes, please understand that for exam purposes, the ones which are getting disallowed is only micro and small enterprises and not medium enterprises. Is that clear? Yes, sweet. Now let's go to the next part of the amendment lectures, which is starting from PGBP, which is starting from capital gains. Now, there are not many amendments in capital gains, but there are some important ones. One which you notice in the period of holding. If you notice in the period of holding, there's one line which comes and says that if at all you are a security which is listed in a recognized stock exchange, then the period of holding generally for you is 12 months. If you satisfy 12 months, then you become a long-term capital asset. If you don't satisfy the 12 months, you become a short-term capital asset. However, amendments of current year come and clarified that if you are found to be an market-linked debenture or a specified mutual fund, what are you? If you are found to be a market-linked debenture or a specified mutual fund, if you are found to be these two items, the amendment of current year comes and says that you will not look for any period of holdings. The asset will directly be always called as short-term capital asset. That's one amendment of current year, which means if you see the question which says market-linked debentures or you see specified mutual funds, you will come and say, you know what, this is a clean-cut specified short-term capital asset, and therefore gains will always be short-term capital gains. It doesn't matter how long you hold it. Again, the provisions relating to this we'll discuss when we do the subsequent part, but the provision is that they have been removed explicitly from all the assets period of holding because they have now been only classified as short-term capital assets. Small amendment of current year. Rahul, what is a specified mutual fund? Specified mutual funds are those mutual funds where less than 35% is invested in equity shares, meaning at least 65% should go to debentures. If at least 65% are going to debentures, then it's called as a debt mutual fund, right? So debt mutual funds or a market linked debenture, in all those cases, it will be classified as a short-term capital asset directly. You will not look for the period of holding. This is one amendment for you to keep in mind. No questions around it because there's all generic things. Next important amendment is coming from your HP chapter. Imagine an example where what has happened is you've bought a land. You've bought a land and you're planning to make a house on it. Yes. On that house, what you're going to do is, because you need to make the house, you need some money. So what you did is you went to the bank and you got a loan. Now, in all practical sense, what will happen is you've taken the loan, the house is still not ready. Now, if you remember when we did HP chapter, we came and called all these items as pre-construction interest. Yes or no? Yes, we call them as pre-construction interest. We said that you are going to claim this pre-construction interest over a period of 5 years. Now, there were some smart assessees in the market. What they started doing is they came and said, yes, you know what? The pre-construction interest which I have, I'll allow it over 5 years. But because this loan was taken prior to the asset coming into existence, this interest which you are paying is similar like borrowing cost. And so they came and said, Rahul, this also should be added to my cost of acquisition. This also should be added to my cost of acquisition. So what they were doing is they were claiming the same interest under HP chapter as pre-construction and under capital gains also as cost of acquisition. Double deductions were coming to them. To avoid that, current year's amendment comes and clarifies that if you have any interest on HP, which you have not claimed as deduction, then only it will be a part of cost of acquisition or cost of improvement. Then only it will be a part of cost of acquisition and cost of improvement. Meaning, if there is an interest on loan which you have paid, for a house property and you already claimed it as a normal deduction or as a pre-construction interest deduction, then in that case you will not get that cost of acquisition, or you will not get that as a cost of improvement for the current year. You will not get it as cost of acquisition or cost of improvement of current year. Yes, fairly simple, straightforward thing. In exam, how you will get a question around this? They'll come and tell you that there is a house for which you have paid interest, and they will come and clarify this interest has already been claimed under HP chapter. In that case, you will ignore that interest, you will not take into consideration. Yes, let's read. It says, interest on loan which is taken for a house property which is already claimed as a deduction under IFHP, or chapter 6A, either of the two. If you have claimed it under 24B or you have claimed it under 80EE or AA, whatever it is, you will not get the deduction under capital gains for it under cost of acquisition. Same line item, you will find it in cost of improvement also. Yes, keep that in mind. That's one amendment of your current attempt. Proceeding forward, the next amendment is the short-term capital gains amendment, which we just spoke about. I'm just going to read it out for you once again so that you understand it properly. Read the line. It comes and says very carefully that if you have a capital gains, which is arising from a transfer or from a redemption of market linked debentures or a unit of specified mutual fund, which I clarified. Unit of specified mutual fund is a case where the investment in equity shares of domestic company is less than 35%. These assets will always be called as short-term capital gains and short-term capital loss regardless of their period of holding. Expect this more as an MCQ level question. Yes, so please keep that in mind. Proceeding forward is the next most important amendment under capital gains. We are looking at something called as investment in house property. Investment in house property. Now, if you recall the provisions of section 54 and 54F, 54 used to come and say that if you are planning to sell a house and in return buy another house, then whatever capital gains you have will become exempted from tax, provided you invest the capital gains into the house. Similarly, if you have any other asset which you are investing in a house, then if you provide and deposit the whole net consideration into the house, then in that case that will also not be taxable. Yes. So what was the provisions? The provisions were section 54 and 54F. In 54 used to come and say that you have a house, you are planning to sell the house and buy a house. And in that you said any other long-term capital asset if you're selling and you're buying a house. In the left side, the provision was that you have to invest your capital gains into the new house. In the right side, the case was that you have to invest your net consideration into the new house. Yes or no? Yes, this is what we discussed. Now, the amendment of current year comes and clarifies that the maximum investment which you can make in a house, should not exceed 10 crores. Should not exceed rupees 10 crores, which means going forward, Rahul, if you are planning to invest in a house, the maximum investment which you can make in one house to get an exemption is only 10 crores. 10 crores. If you make an investment more than 10 crores, they will assume that the investment is not made. They will assume that the investment is not made. Yes or no? Let me give you examples. Let's say, for example, you are under section 54. You are under section 54. Your capital gains was, let's say, 3 crores. Your capital gains was 3 crores. In the new property, you invested 3 crores. How much exemption will you get, Rahul? You will get exemption of 3 crores. Yes. If you had investment of capital gains of 3 crores, you invested only 1 crore, you will get an exemption of only 1 crore. Yes. If you had capital gains of 3 crores, you invested 4 crores, I will give you an exemption of only 3 crores because obviously you have had a capital gains only of 3 crores. Assuming I change the numbers, assuming that my capital gains was 30 crores, I had invested 9 crores, I will get exemption of only 9 crores. I had 30 crores, I invested 10 crores, I will get only 10 crores. But if I had capital gains of 30 crores and I invested 20 crores, I will now get exemption of only 10 crores. Why, Rahul? Because provisions come and say that the new house can have investment only of maximum 10 crores. Meaning, Rahul, even if I go ahead and invest 30 crores and fully I deposit, still I will get exemption of only 10 crores because income tax comes and says, I'm sorry dear, but you will only get the house property maximum 10 crores investment. You will get a house property investment of only maximum 10 crores. Yes. So amendment of current year, section 54. Things become a little more challenging when you're in 54F. When you're in 54F, notice this very carefully. I am saying, Rahul, my net consideration is my net consideration is 30 crores. My net consideration is 30 crores. My capital gains is 3 crores. My capital gains is 3 crores. How much will I invest? I have to invest the whole 30 crores of net consideration. I have to invest the whole 30 crores of net consideration only to get a capital gains exemption of 3 crores. But the problem is income tax now comes and says you cannot invest more than 10 crores. You cannot invest more than 10 crores, which means I can maximum make an investment of only 10 crores. I can maximum make an investment of only 10 crores. Now ask yourself, Rahul, the consideration, if it was 30 crores, you invested 30 crores, you would have got an exemption of 3 crores. Since you only invested 10 crores, you will only get an exemption of 1 crore. You will only get an exemption of 1 crore. Yes or no? Yes. I will change the example. Let's say it is 3 crores. Capital gains is 30 lakhs. Capital gains is 30 lakhs. In that case, Rahul, I can invest how much? I can invest full 3 crores in order to get an exemption of 30 lakhs. Yes, because the investment is less than 10 crores, therefore there is no problem. That is how 54 works, right? It's a proportionate base method. It's a proportionate basis method. The rule is very simple. If you are going to have a net consideration of 30 crores, capital gains being 3 crores, even if you invest 30 crores, income tax will assume that you have only invested 10 crores and the corresponding exemption against that will only be 1 crore. Rahul, why are you not putting 10 crores? Understand, for 54F, it is a proportionate model. Had you invested 30 crores, you would have got 3 crores. Since you only invested 10 crores now, they will only give you exemption of 1 crore. They'll only give you exemption of 1 crore. A critical amendment of current year. Expect questions around this in exemption chapter. Please be very careful. This is a 54 and 54F amendment alone. The maximum investments which you can now make in a house property cannot exceed 10 crore rupees. The maximum investment which you can make in a house property now cannot exceed 10 crore rupees. Yes or no? Yes. Keep this in mind. We will proceed forward. The provisions are coming and saying that if you have an investment to make, you can make a maximum investment of 10 crores in house. Because it is 54, you'll get a maximum exemption of 10 crores. But if it is 54F, you can maximum invest only up to a 10 consideration of 10 crores. You can invest only up to a maximum consideration of 10 crores. Yes, please keep this in mind. A very critical amendment of the current year. Apart from that, there is no other amendments in capital gains chapter, so we are proceeding forward. We are proceeding forward, which means Rahul, two amendments to be kept in mind in capital gains chapter. One is of the fact that if you have any kind of market linked debentures and all, then that will always be treated as a short term capital gains. Second is this investment maximum of 10 crores. And yes, there is one more small amendment which is about the HP chapter, where they're coming and saying if you have interest on loan which you have already claimed under HP chapter, you will not get it under capital gains. You will not get it under capital gains. Yes, three amendments for you to keep in mind in your capital gains chapter. Fairly straightforward amendments, just be very careful about it. Yes, proceeding forward, you have no amendments in distribution chapter, you have no amendments in business reorganization. You have one very critical amendment coming in when it comes to IFOS chapters. You have two critical amendments coming in from IFOS chapter. Critical amendment number one is your section 5627B. 5627B basically is a section which comes and says that if you are a closely held company, or in simple words, a private company, if you are a closely held or a private company which is planning to issue shares to your shareholders at a premium, in that case, you have to ensure that the shares are not issued beyond the fair market value of the shares. If it is issued beyond the fair market value, then the fair market value minus consideration will become IFOS income. We would have discussed this in detail. If you are not aware about it, just go back to the book and read it once again. Yes. Now, until last year, what used to happen is this provision was only applicable in case you are issuing the shares to a resident person. The provisions were only applicable in case you were issuing the shares to a resident person. Current year amendment comes and says that you can issue now these shares to any person and be taxable for it. Meaning, even if you issue the shares to a non-resident person, it will still become taxable under the Act. It will still become taxable under the Act. So, current year amendment, you have to make sure that the issue is not happening at a premium. If it is happening at a premium, it is not being sold more than the fair market value. It doesn't matter who the shares are being given to. It doesn't matter who the shares are being given to. This is what the amendment of current year is. Yes, one amendment from the 5627B chapter. Yes, second amendment is your LIPs. Now, this amendment, before I start itself, let me clarify to you, is not applicable in the current year from an exam descriptive perspective. Is not applicable in the current year from an exam descriptive perspective, because it's an amendment of the current year. The maturity of it will take some time. The taxability will not happen in the current year, and therefore this will not be generally tested in the descriptive questions in the current year. But basis what I see in the RTP this time, you can expect questions around this in MCQs. Okay, so from an MCQ perspective, please keep this in mind. Other than that, computational level, this question will not be tested. Let me give you a background about this new amendment. The provisions of this are as follows. Until last year, if you would have remembered, when we did chapter 6A ATC, there was a provision where they used to come and say that if you are under ATC and you're paying a life insurance policy, in that case, whatever premium you pay on the life insurance policy was treated as an ATC deduction. But you had some conditions. Condition was that your life insurance premium should not exceed more than 20% or 15% or 10%. You know all those things. Yes. Until last year, what was happening is people, what they used to do is they used to take life insurance policies from various people. And they were investing in that. Obviously, you're investing and you're getting back the money tomorrow. Yes. Now, what was happening is people were investing that, claiming ATC. Now, that is not a problem. But the problem, what happened is government suddenly came and said, you know what, the investment has become so huge that I am not able to use the money properly now. People are treating this as an exempt vehicle and they're putting all their investments here rather than putting it in shares or FDs and all those things. LIP itself has become an investment scheme for everyone. Yes. To de-encourage all those things, to disencourage all those things, is when income tax this year made an amendment. Now, there was already an amendment similar to this in ULIPs, unit linked insurance plans, but that was a final level portion syllabus. In inter level, it was not tested, and therefore current year unit linked insurance policies has been removed and moved to finals, but LIP has been kept. Now, Rahul, what is this amendment? Amendment says very simple. It says earlier also the provision was that if you are going to have a life insurance policy where the premium is going to go beyond the 20% or 15% or 10%, the policy becomes taxable. But there was no clarity as to where it was being taxable and how much was it taxable. First thing which they clarified in this amendment is that if this policy is taxable, which means if the premium is more than 20% or 15% or 10%, the policy becoming taxable will become taxable under that IFOS. The first thing, a clarification. Things which were already taxable earlier is now going to be taxed even now, just that it will be taxable under IFOS. First clarification. Second, they came and said, Rahul, assuming you have taken policies, and the policies are less than 20% or 15% or 10% as the case may be. If you've taken policies and the policies are less than 20, 15 or 10% as the case may be, but the problem what is happening is this policies you have taken, the premium on these policies are more than 5 lakh rupees per year. The policy premium is more than 5 lakh rupees per year. For example, I went to, let's say, Life Insurance Corporation. I went to LIC and he came and said, I want a 5 crore policy. I want a 5 crore policy. They came and said, sir, 5 crore policy, 10% is the premium, therefore pay 50 lakhs to me. Pay 50 lakhs to me. I'm paying yearly premium of 50 lakh rupees. I'm paying a yearly premium of 50 lakh rupees. Now, technically, I'm within 10% bracket. So, therefore, the policy is exempt. Income tax this time came and said, no. Even though the policy was exempt because of the 10% bracket, understand very carefully what is happening is the policy's premium is more than 5 lakh rupees. The policy's premium is more than 5 lakh rupees, and therefore income tax this year came and said this policy will going forward become taxable. The policy will going forward become taxable, meaning even though the policy was less than 10% of the sum assured, still the policy premium is more than 5 lakh rupees, and therefore this policy now becomes taxable. This policy now becomes taxable. Now, Rahul, is this there for every policy which you've taken in the past? We were not aware about it. No. This policies, this amendments are only applicable from financial year 23-24, and therefore this is only applicable for those policies which are enforceable after 1st April 23. Meaning, if you have taken a policy before 23, this will not be covered. If you have taken a policy before 23, it will not be covered. It is only covering those policies which are taken after April 23. After April 23. If you have taken a policy after April 23 and the premium on that policy is more than 5 lakh rupees, income tax will now come and say this policy becomes taxable under the head IFOS. This policy now becomes taxable under the head IFOS. Rahul, how much is going to be taxable? Obviously, the premium which you pay will be reduced and the maturity amount which you're going to get will become taxable. So, it will be maturity minus premium paid will become your gains, will become a profit which will be taxable under the head IFOS. Now, Rahul, when will it be taxable? Obviously, in the year in which the maturity happens or the surrendering happens. In the year in which the maturity happens or the surrendering happens, which is why I came and told you that the amendment is not applicable for your current year descriptive questions, because if you are going to issue a policy in the current year, the likelihood that you will mature the policy in the current year itself is very zero. It's very zero, and therefore generally what will happen is this provisions will only come into picture at least 3-4 years later, where their policy will start maturing and therefore you can tax things. Yes. As of now, for an MCQ perspective, please note that if the policy is taken after April 23 and the premium on the policy is more than 5 lakh rupees, income tax says this policy is now going to become taxable. This policy is now going to become taxable. Yes or no? Yes. Now, before I answer something else, let me also clarify to you, the 5 lakh rupees which I am talking about is the actual premium. Is the actual premium, meaning if you are going to pay GST on this, GST will not be considered. GST will not be considered. CBDT clarifications where they are coming and clarifying that if you have paid a policy premium of 5 lakh rupees excluding GST, that is what will be considered. Excluding GST, that is what is going to be considered. I will not come and ask you for the policy including GST. No. Which means if you've taken a policy for 5 lakh rupees and added 18% GST on this, your policy is still exempt because the premium is less than 5 lakhs. The premium is less than 5 lakhs. For the purpose of checking your premiums, it is not including GSTs. It is not including GSTs. Is that clear? Yes. Now, second, Rahul, I may be smart. Imagine a scenario where I'm coming and saying, you know what? If you're telling me that the policy is going to become taxable if you take a premium more than 5 lakh rupees in that policy. So what Rahul did is smartly, Rahul went and he bought 3 policies, LIPA, LIPB, LIPC. Yes. Now Rahul also smart. He came and said, no, 5 lakh rupees is the problem. No, so let me do one thing. I will not buy a policy worth 5 lakh rupees itself. I'll take 3 different policies. Policy number 1, I'll pay a premium of 2 lakh rupees. Policy number 2, I'll pay a premium of 2 lakh rupees. Policy number 3, I'll take a premium of 2 lakh rupees. Now, total I am paying in the current year 6 lakh rupees, but each policy is not more than 5 lakhs. Income tax said, no, don't play smart with me. Don't play smart with me. If it is found out that the premium in any one of the year exceeds 5 lakhs, the premium in any one of the year exceeds 5 lakh rupees, in that case also, the policies will become taxable. Now, Rahul, in this case, will all the 3 policies become taxable? No. Income tax said, you do one thing. If all the policies have now become taxable because the premium in the current year is more than 5 lakh rupees, you decide which policies you want to exempt. The condition is very simple. If you are going to exempt some policy, the premium on those policies should totally not exceed 5 lakh rupees. should totally not exceed 5 lakh rupees. Meaning, Rahul, can I add all the three and exempt? No. I will have to either exempt 1 and 2, or I'll have to exempt 1 and 3, or I'll have to exempt 2 and 3. Whose choice? Rahul's choice. Rahul's choice. He can decide which policy he wants to exempt. He can decide which policy he wants to exempt. In simple words, Rahul, two conditions given to you. Condition number 1, if you have taken one single policy only, then the policy premium should not exceed 5 lakh rupees. If you have taken multiple policies, then the total of all the premiums on those policies should not exceed 5 lakh rupees. Should not exceed 5 lakh rupees. If it is exceeding 5 lakh rupees, then in that case, you can choose which policies you want to exempt, provided the premium on those exemption policies do not exceed 5 lakh rupees. Get that condition satisfied, the policy will become exempt. Balance policies will become taxable. Balance policies will become taxable. Now, the trick in this question is that income tax says, Rahul, it is not that it is not that the first year this premium should not exceed 5 lakh rupees. Anytime during the life of the policy should not exceed 5 lakh rupees. For example, let's say I took the first policy on 1st April 24. I took the third policy on 1st April 24. And I took the second policy on 1st April 25. Now, if you notice, what is happening is policy number 1 and policy number 3 is together taken in 24, which means the total of those policies is only 4 lakh rupees. So you will come and say me, Rahul, the policy is exempt. The policy is exempt. Answer is no. Answer is no. Please understand, if I have taken the policy in 24, obviously I have taken it for let's say at least 10 years. Here also I have taken it for 10 years. Second one is also gone for 10 years, which means what will happen in 24-25 I would have paid only 4 lakh rupees, but in 25-26 I'm going to pay premium on all the three. Yes or no? In 25-26 I'll pay premium on A also, B also, C also, which means 25-26 if I check, I have actually paid a premium of 6 lakh rupees. Income tax will come and say, Rahul, the moment you paid 6 lakh rupees in 25-26, all the three policies became taxable. All the three policies became taxable. Now you need to make a choice and tell me, Rahul, which two policies do you want to exempt in order to come down to less than 5 lakhs? In order to come down to less than 5 lakhs. Yes, a little bit of a challenge to understand few things, but a very, very easy provision. A very, very easy provision. To make it easier for you, what we'll do is we'll do some questions. We'll do some questions. Let's see if you understand from the questions properly. Okay. Yes, you can read the theory on your own. It's pretty much making sense. I'm going to take 1 second. I'm going to keep it like this. Feel free to pause the video and read it once again. Yes. Here. Take a minute and read it once again if you want to. Let's do the examples. Let's do the examples. Look at question number 1. Look at question number 1. It says, there is single LIPs I'm taking, which means one person. I'm giving you 3 scenarios. Scenario number 1, he's taken a policy in 2013 and has paid a premium of 6 lakh rupees with sum assured 60 lakh rupees, maturing in 2023, and the capital consideration is 70 lakh rupees. 70 lakh rupees. Looking at case number 1, will you tell that the policy is taxable? No. You will say the policy is not taxable. Rahul, why is the policy not taxable? Because of the fact that the policy was taken in 2013. The policy was taken in 2013. Even though the premium on this policy is more than 5 lakh rupees, it doesn't matter because the policy is before 2023. And therefore, policy number 1 will become exempt from tax. Policy number 1 will become exempt from tax. Yes, going to policy number 2. The policy is now taken in 1st April 23, which means it is within the current year, so no problem. The premium on this policy is 6 lakh rupees, the sum assured is 60 lakh rupees, and the consideration is 70. Now, notice this policy on a standalone basis. This policy itself has premium more than 5 lakh rupees, which means this policy now becomes taxable. This policy now becomes taxable. Rahul, how will you tax it? Obviously, you will take the premium of 6 lakh rupees. The consideration which you are going to receive is 70 lakh rupees. How many premiums are you going to pay? You are going to pay 10 premiums. So 6 lakhs into 10 will give you 60 lakhs, which means the taxable capital gains will become 10 lakhs. The taxable IFOS will become 10 lakhs. Sorry, not capital gains. The taxable IFOS will become 10 lakhs. Yes. Coming to case number C. The policy was taken on 23, which means after the year amendment introduced. The sum assured is 50 lakh rupees. The premium which you have paid is 5 lakh rupees and the consideration is 52. Notice very carefully what is happening is the premium which you have paid is 5 lakh rupees. The premium which you have paid is 5 lakh rupees, which is still within the limit, and therefore this policy also becomes exempt from tax. This policy also becomes exempt from tax. Yes, simple, straightforward things. Moving forward, I am looking at now multiple policies. Look at case number A. I am coming and saying, Rahul, LIP A and LIP B Both the policies are taken in 2023. Premium on one policy is 4,50,000 and premium on second policy is 5,50,000. Premium on second policy is 5,50,000. Now here itself I will stop and I'll come and say, you know what, Rahul, one person has taken multiple policies, but in that multiple policies, one policy is directly taxable, which is LIP number B. Which is LIP number B. Why, Rahul? Because this policy standalone itself is more than 5 lakhs. This policy standalone itself is more than 5 lakhs. So I will come and say, you know what, tax LIPB directly. Tax LIPB directly. Now if I tax LIPB, I'm now going to LIPA. Now LIPA premium is only 4,50,000. I told you, you can claim an exemption of 5 lakh rupees in the current year, which means LIPA will become exempt from tax. LIPA will become exempt from tax. Getting it or not? Yes, meaning if any policy is less than 5 lakh rupees, that policy will be exempt, provided you you prepare a combination in such a way where the total premium does not exceed 5 lakh rupees. So LIPA, I will say yes, standalone basis, looking at that policy alone, it is more less than 5 lakh rupees. So therefore, I am assuming it as exempt. Coming to case number B. Now look at case number B. You have 3 LIPs. One is case A, one is LIPA, LIPB, and LIPC. Now all the policies are taken in 2023, therefore there is no problem. Look at the premiums. First premium is 1 lakh, second premium is 3,50,000, third premium is 6 lakhs. Now the moment I see 6 lakh itself, I'm going to come and say, you know what, LIPC is taxable because it is more than 5 lakh rupees. Don't even bother. Now look at the balance 2 premiums. Balance 2 premiums together is 4,50,000. Balance 2 premium together is 4,50,000, which means this is not taxable. You'll come and say, Rahul, I'm choosing to make these 2 policies as exempt and therefore it is not taxable. Simple. Yes. See if you can understand the last question and then it makes sense. I'm having multiple LIPs purchased pre and post 2023. First policy is 2022. First policy is 2022. Now, if you remember the 2022, this provision itself is not there of 5 lakh rupees, which means that time you need to check for the 10% bracket. My sum assured is 50 lakhs. My premium is 5 lakh rupees, which means this policy is within 10% and therefore the policy is exempt from tax. Look at the balance 3 policies: LIPA, LIPB, LIPC. Now you have LIPA, LIPB, and LIPC. In that, if I check, LIPA is 1 lakh, LIPB is 3,50,000, LIPC is 6 lakh. The moment I see 6 lakh itself, I'm going to come and say, you know what, LIPC is taxable. Meaning, it leaves me with 2 policies, which is LIPA and LIPB. If I add these two policies, the number is 4,50,000, which is still less than 5 lakhs. And therefore, I will consider these 2 policies as exempt from tax. I'll consider these 2 policies as exempt from tax, which means I'm only going to call LIPC as taxable. Yes or no? Yes. Last question. Look at the policies. You have LIPX, LIPY, LIPA, LIPB, LIPC. Okay, 5 policies you have. If I notice the policies very carefully, what is happening is some policies are 2 lakh, 2 lakh, 2 lakh, 3 lakh, and 6 lakh. The moment I see 6 lakh, I'm going to come and say, you know what, LIPC is taxable, don't worry. Which means now I have 4 policies. X, Y, A, and B. Notice the dates very carefully. X and Y is maturing. X and Y starting in 23. A and B is starting in 24. Which means in 23 only 2 of the policies were in force. And if I add the premium on those 2, it is 4 lakh rupees. Which means till 23 these policies were exempt. But now come to 24. Rahul, will you pay premium only on X and Y? No. Obviously, you'll pay premium on X, Y, A, and B. Which means all the 4 will be paid. Now, if you're taking all the 4 together, it is 2 plus 2, 4 plus 2, 6 plus 3, 9. Which means you will end up paying 9 lakhs worth of premium in 24. Now, if you're going to pay 9 lakhs worth of premium, income tax will come and say you cannot pay 9 lakhs, you can only pay 5 lakh rupees. Which means all the 4 policies are taxable now. You will come and say, no, sir, all the 4 and all is too much. You give me an option, let me exempt some things. So he says, okay, great. If you want, go ahead and exempt some policies, provided the premium on those policies does not exceed 5 lakh rupees. Yes. Now, if I notice, what is happening is I have to do some combination in such a way where the policies is less than 5 lakhs and exempted. I think the best way to do it is be a smart person and see how much will be the income which you're going to tax. How much is the income which you're going to tax in each policy? Let's look at the first policy. The provision says that the premium which you're paying is 2 lakhs, surrender value is 27, and the consideration received is 12 lakhs. Which means you're going to receive 12 lakh rupees on maturity. For you to pay some premium which is paid over how many years? Check 23 23, 24, 25, 26, 27, 5 years. Yes, so you're going to pay 5 years worth of premium and you're going to get a consideration of 12 lakhs. 5 years into 12, 2 will become 10 lakhs, which means the gains which you're going to get in this is 2 lakh rupees. The gains which you're going to get in this is 2 lakh rupees. Yes or no? Yes. Look at LIPY. Look at LIPY. You have taken the policy on 23, the maturity is 33, which means almost about 10 years. Almost about 10 years. In this 10 years, what is going to happen is this policy will get you an total premium payment of 2 lakh into 10, which is 20,000. You're going to get a maturity of 24 lakhs, which means you're going to get a profit of 4 lakh rupees. You're going to get a profit of 4 lakh rupees. Moving forward, you have LIPA. You have LIPA. The policy was taken in 24. The policy is maturing in 34. Again 10 years. Again 2 lakhs and 24 lakhs, which means again this is going to become 4 lakh rupees. Hey, hello. Yes, coming to the last policy, you have taken it in 24, you are maturing in 34, you have to pay a premium of 3 lakhs per year, 10 years you have to pay, which is 30 lakh rupees. Maturity is given as 36 lakhs, which means you will tell this as 6 lakhs of profit. You will tell this as 6 lakh of profit. Now I know how much profit I will make from each of the policies. Now, if I know the profit, it is easier for me to come and say, Rahul, which one should I exempt? Which one should I exempt? Obviously, logical person would come and say, Rahul, maximum income exempt better. Exempt the maximum income, that is better. So therefore, LIPB will become exempted. LIPB will become exempted. I'll come and say, you know what, I don't want to earn an income of 6 lakh rupees and all, it will become taxable for me. Therefore, let's take LIPB as exempt. LIPB as I made a choice now. LIPB has become exempt. The premium which I have exhausted is already 3 lakhs. The premium which I have exhausted is already 3 lakhs, which means I still have 2 more lakhs worth of premium which I can exhaust. 2 more lakhs worth of premium which I can exhaust, in which I have X, Y, and A in my hand. I have X, Y, and A in my hand. Now, obviously, I would come and say, Rahul, let's make excess taxable. Let's make excess taxable because the income on that is only going to be 2 lakh rupees. The income on that is only going to be 2 lakh rupees. So, you will treat excess taxable, which means now you know that you only have 2 policies left, which is Y and A. You only have Y and A, and you need to now make a decision, Rahul, whether you will tax Y or you will tax A. You will tax Y or you will tax A. Now, if you technically notice, the profit in both the cases are 4 only, so it doesn't matter. It doesn't matter, you can choose anyone. But a smart person will look at the dates properly. A smart person will look at the dates properly. Notice this carefully. Notice this carefully. What is happening is, you are coming and saying, Rahul, the LIPC is taxable. The LIPC is taxable in 2034. The LIPC is already taxable in 2034, which means in 2034 you're already going to offer income worth maybe about 10 lakhs. So 6 into 10 is 60, so 10 lakhs. You're already going to offer an income worth 10 lakhs in 2034, which means in 2034, if you make something as taxable, it will again jump more. Already you have 10 lakhs, one more thing will jump to it. And that will become taxable at 30% bracket because you've already exhausted this, no? Yes or no? Slab rate model, old regime. You will pay 30% tax on those things. So which means you will not prefer to tax something in 34. You will not prefer to tax something in 34. Now let's look at the dates. LIPY will become taxable in 33. Whereas LIPA will become taxable in 34. Will I want to tax something in 34? No. I will say no, don't tax something in 34 because if you end up taxing something in 34, C also is 10 lakh rupees, this also is 4 lakh rupees, total income will become 14 lakhs taxable in one single year. I will come and say, let's do one thing, let's exempt LIPA. Let's exempt LIPA. In this case, what will happen, Rahul? LIPY will become taxable in 33, 4 lakh rupees, claim rebate, no tax. LIPC will become taxable in 2034, 10 lakh rupees. At least slab rates you will be able to save something. Which means you will be able to optimize your taxes in such a way by choosing the best of the policies. Now, this is what a smart person will do, is what I'm saying. It is not mandatory that this is what is to be followed. Sometimes what may happen is a person may come and say, you know what, LIPX I treated as taxable. Person in 2037 may have become very, 2027 would have become very excited and hyper. He may have in 2027 come and said, you know what, I want this as exempt. Which means he would have already treated the 2 lakh sort of policy as exempt already. Which means in that case, you cannot do anything. You will lose exemptions. You would have claimed the exemption for B and X. And you will have to tax no other options Y, A and C. This is the kind of question which ICA will ask you. First, they'll come and ask you, Rahul, what is the best of the policies to be exempt? Second, they'll come and ask you, if you have chosen earlier something else, does this impact your answer? You have to say yes. You have to say yes. Look at RTP case study number 1 and case study number 2. Same questions you will see there also. Same questions you'll see there also. This itself is a very good question for you to answer yourself. Logics are given in the table on the bottom. You can pause the video and you can check the logics once again very carefully. But a very, very interesting kind of provision which has been introduced. Nice provisions. Tests you more on your analytical skills. Test you more on your analytical skills and your decision making capabilities. Yes, so please keep that in mind. A very easy provision is what I would say. Again, MCQ level question, not a descriptive level question, so don't worry about it too much also. Let's proceed forward. Let's proceed forward. We are going forward to the next chapters. There is no amendments in dividends. There is no amendment in clubbing. Definitely no amendment in set off. Chapter 6A has a very small amendment which you need to, I think we already discussed this when we did salaries chapter. When we did salaries chapter, I came and told you that the current year government has introduced something called as Agniveer Corpus Fund, and government comes and says that government will contribute something to Agniveer Corpus Fund. If government is contributing something to Agniveer Corpus Fund, that will become taxable under the head salaries, because we're going to collect the same as deduction in 80 new section CCH. You're going to claim that as the same exemption under 80 CCH. So 80 CCH comes and says, similar to national pension scheme, that if someone is going to contribute to Agniveer Corpus Fund, whatever you contribute will be allowed as a deduction, whatever government also contributes will be allowed as a deduction. Simple, straightforward case. Simple, straightforward case, nothing complicated about it. If you know NPS properly, you know this also. If you know NPS properly, you know this also, nothing complicated about it. Please keep that in mind. Yes. Proceeding forward, I think that's this one amendment is probably something for you to know. It's not there in the material. I'm just clarifying it to you once again. For those students who are reading the material, reading their concepts from November 23, for those students who are reading their concepts from November 23, ATG donations category B, ATG donations category B, you may find some 4 items extra: Indira Gandhi Fund, Rajiv Gandhi Fund, Jawaharlal Nehru Fund and everything. Current year amendment, they removed all those funds. Current year amendment, they removed all those funds. Now there is only one fund which is there in category B, which is Prime Minister Drought Relief Fund. Yes, anyway, you don't have to worry, because if it is removed, then the exam is not going to ask you for it, but it's good to know. It's good to know. Tomorrow you should not come and ask, Rahul, your book is not having it and that book is having it. November 23, it was there. May 24, they have scrapped those 4 kind of funds, and therefore now you only have one fund called as Prime Minister Drought Relief Fund in category number B. Please keep that in mind. Yes. Proceeding forward, you have I think your chapter 6A is done. You are then going to TDS. In TDS, you only have one amendment of the current year. We have already discussed this amendment when we did winnings. Rates of taxes we discussed. No, there was something called as online winnings introduced in the current year. Income tax comes and clarifies that if at all there is any online winnings happening, same as winnings, you will now have to deduct TDS at the rate of 30% on it. You'll have to deduct TDS at the rate of 30% on it. Rahul, who will deduct? The platform owner will do it. The platform owner will do it. The platform owner will come and take all your winnings and then deduct TDS at the rate of 30% on this. We already did the computation when we did rates of taxes. That time itself I clarified to you that if you have something which is withdrawn in the current year, TDS will happen immediately on that. But if you don't have any withdrawals happening, then TDS will be deducted from your closing balance and deposited to the government. So those are some few things which is already happening. The winnings conditions are only that your winnings should be more than 10,000 rupees in the current year. Oh, it's not there. Okay, so maybe the clarification is not notified for you. The clarification was that if the winnings is not more than 100 rupees, and in that case winnings will not be liable for TDS and all those things. But anyway, it's not been notified for your syllabus, so you don't have to worry about it. It's more in final maybe. Yes, just keep this in mind that whatever is the winnings computation you do in rates of taxes, same computation you will follow here. Just that TDS will happen at 2 levels. One is at withdrawals, one is in closing balance. So whatever winnings you tax already in withdrawals, that will have winnings TDS already, and then whatever is the balance left in closing balance, that you will do TDS once again. Both are happening at the rate of 30%. Both are happening at the rate of 30%. Please keep that in mind. That's all is the amendment, nothing great about it. Yes, apart from that, you have no amendments in TDS. You have one very important amendments which have come in TCS. You have some very important amendments which has come in TCS. TCS in the current year has undergone a significant amount of change. So expect MCQ level questions in this also. You have already some questions relating to this in your RTPs. Yes, what is the amendment, Rahul? Until last year, there was a provision in TCS which used to come and say that if you're making a foreign payment, then whatever foreign payment you make up to 7 lakh rupees, there will be no TCS. Up to 7 lakh rupees there will be no TCS. After 7 lakh rupees, whatever payment you make, the authorized dealer through which you make the payment will collect a TCS at the rate of 5% from you. Will collect TCS at the rate of 5% from you. That was until last year. That was until last year. After that, what happened is income tax recently brought in a circular. Income tax recently brought in a circular and came and said, you know what, the 5% looks very small. The 5% looks very small. I want to really discourage people to make payments foreign countries. I want to really discourage people to make payments in foreign countries, and therefore I am not happy with this 5%. Let's increase limits. Let's increase limits. The notification, the notification came somewhere in 30th September. So it starting 1st October, there is a new change. Starting 1st October, there is a new change. What are the changes, Rahul? The provisions first come and say that, Rahul, for the first 7 lakh rupees, last time also there was no TCS, now also there is no TCS. After 7 lakh rupees, I will start asking you, tell me what is the reason for which you are making the payment. Tell me what is the reason for which you're making the payment. You tell me that, Rahul, the reason why I'm making the payment is because my children or me or my spouse are studying outside India for an education. For which I've taken a loan from a bank. So income tax comes and says, Rahul, if you have taken a loan from a bank for doing higher education outside India, there is a section called as 80E. Which comes and says that whenever you have any interest on loan taken from a foreign bank, interest on loan taken for education, whenever you have any interest on loan taken from an education, then the interest will be allowed as reduction under 80E. Now, TCS chapter comes and says that if you have a loan taken for educational purposes outside India, then for the first 7 lakh rupees, there is no TCS. After 7 lakh rupees, whatever payment you make will be liable for TCS at the rate of 0.5%. Will be liable for TCS at a rate of 0.5%. Yes. Now this was there last time also. This is there now also. There is no change in this. The rate has remained the same. Which means for the first 7 lakh rupees, authorized dealer will not ask you any questions. After 7 lakh rupees, whatever payment you make, first level of payment, if it is a educational loan taken for foreign country educations, then in that case the TCS will go at 0.5%. Second, this year income tax is notified that if you are going to make the payment outside India, for medical purposes, what purposes? Medical purposes. Or if you're going to make the payment for educational purpose but not by way of loan, which means you itself have money and you're giving it for education. It's not from the loan and all. In that case, the rate will remain same as last year, which means 5%. Till last year also the rate was 5%. This year also the rate is 5%. So if the payment is happening for an educational loan, then it is 0.5. If the payment is happening for normal education, it is 5. If the payment is happening for medical also, it is 5. Rahul, anything else I make a payment. For example, normal gift I'm giving, a normal personal payment I'm making, some money I'm transferring and all those things. Until last year, the payment was 5%. The TCS rate was 5%, which means for the first 7 lakh rupees, you will not do TCS. But after 7 lakh rupees, if you make a payment, the payment was like for 5%. Current year amendment, they come and say, Rahul, if you make a payment above that, it will become 20%. If you make a payment above that, it will become 20%. Now, please keep this in mind, Rahul, it's not 7 lakh rupees for each nature. It is 7 lakh rupees cumulatively. Meaning it will be on a date basis. First date when you make a payment, first 7 lakh rupees, they'll not ask you. Then after that, they'll start asking you every single time a question as to what is the reason for payment. You say, Rahul, it is an educational loan, they'll do 5.5%. You say it is normal education, 5%. You do normal medical, it is 5%. If it is any other reasons, till September, they will do 5%. After September, they will do 20%. Yes or no? Please keep this in mind. Proceeding forward, Rahul, until last year, there was also this condition that if you have not taken this for any kind of payments and all, but it's more for an overseas travel package. If it's for an overseas travel package, meaning if you have planned for some honeymoon travels or you're going for some foreign country trips and all, 4 night, 5 days package and all those things. Any kind of overseas travel package, till last year, income tax used to come and say that TCS will apply on every rupee. There is no 7 lakh exemption and all. TCS will apply on every rupee and the rate will be 5%. Current year amendment comes and says that, Rahul, for the same package, I will remain and keep it at 5%. For the first 7 lakh rupees. After 7 lakh rupees, whatever payment you make will be 20% now. Which means for the first 7 lakh rupees, you'll do 5%. For the balance items you will do 20%. For the balance items you will do 20%. No exemptions on this, no limit bracket, no limit bracket. That is how the amendments are. That is how the amendments are. Please keep in mind these amendments. Please keep in mind these amendments. Next, a clarification for you. Rahul, what do you mean by an overseas travel package? They are coming and clarifying that overseas travel package is not a standalone item. It's not a standalone item. It's a package. It's a package, meaning at least 2 out of the following 3 items should happen. At least 2 out of the following 3 items should happen. First, either the person should help you book the international travel ticket, or the person should help you with the hotel accommodation. Either 2 out of the 3 should happen. So they're coming and saying, Rahul, either the person should be helping you with travel ticket, or he should be helping you with hotel accommodation, or he should be doing any other similar expenditures, If he's doing any 2 out of the 3, then it will be called as a travel package. If he's doing any 1 of the 3, then it is not a travel package. It is not a travel package, meaning I've gone to him and I've told you book the tickets, balance I will take care, no package. You gone to him and you told I will take care of hotels, you do just the tourism for me, no travel package, etc. Please keep this in mind. Yes, apart from the TCS is also fairly over. Next chapter is your payment of taxes. No changes in the payment of taxes this year. You have your return filing chapter. Now in return filing chapter there is not much amendments, but there is one small thing which you need to keep in mind, which is relating to your Aadhaar card. Now there is no amendment per se. The dates have already been notified till last year. They've just given clarifications this year. The clarification is in the sense that if your PAN and Aadhaar is not linked, what exactly will be the problems to is what is covered now. They have clarified that if you are not linked your PAN with Aadhaar, then the following issues can happen to you. Issue number 1, they will stop giving you any more refunds. So they've clarified to you that if you have any refund due, we will not give you the refund unless the PAN and Aadhaar is linked. You get the linking done, then only we'll give you the refund. Second, no interest will be payable on such refund, meaning if at all you have any refund due but you're not getting the refund, tomorrow you cannot come and say yes, I will link it later. Whenever I'm linking it, that time you give me interest. They said no interest, because it is a mistake from your side that you did not link your PAN with Aadhaar. The refund will be given just like that to you without any interest. Third, they're coming and saying the TDS which is supposed to be deducted will now be done as per the 206 AA rates, which is the 20% rate, because I will assume that the PAN is invalid. Same thing will happen for TCS, where the rate will become twice the rate or 5%, whichever is higher. They're just clarifying to you that if at all you don't link your PAN with Aadhaar, the following 4 issues can happen. This is more theoretical question. Now Rahul, all this has started happening. I've now realized my mistake. Can I never correct it? You can correct it. Income tax comes and says that if at all you now link your PAN with Aadhaar, and you pay the late filing fee which was discussed last time itself, then in that case I will link your PAN with Aadhaar, but it will take at least 1 month for me. So they're coming and saying where the Aadhaar number is intimated and the late filing fees is paid, the PAN would become operative within 30 days of such intimation. So they're just giving a small clarification to you. It will happen. Yes or no? Yes. This is your return filing chapter. And okay, one important amendment which I wanted to discuss with you in detail is your 10AA. 10AA was your SEZ provisions. And if you recall your SEZ provisions, the provisions used to come and say that if at all you have an SEZ unit, for the first 5 years, whatever is your export profits which you have, 100% of the export profits will be allowed as a deduction. For the next 5 years, it will be 50% of export profits, and for the last 5 years, again, it will be 50% of export profits, provided you also have to invest the money in SEZ reinvestment reserves. Yes, we discussed this. Yes. Now, what happened is until last year, whenever we used to do the word export profits was nothing but the total profits of the SEZ unit into ETO by TTO, export turnover by total turnover. And the definition of export turnover is very simple. It was saying that the consideration should be received into India. Now, for those students who have learned from me in the past, I would have always come and made a fun about this, where I would have come and told, you know what, Rahul, money should be received into India is great, but when should we receive the money is not clarified anywhere. And therefore people were making jokes about this, where they were coming and saying, yeah, I will get the money 6 years later. What is your big deal? You give me that exemption today itself. Yes, to avoid all those mishappenings, current year amendment comes and clarifies that if at all you are going to have any consideration from foreign countries, if you want that consideration to be a part of your export turnover, please ensure that you get the money within 6 months from the end of the financial year. Please ensure that you get the money within 6 months from the end of the financial year. If you don't get the money within 6 months from the end of the financial year, I will not take it as a part of the consideration itself. I will not take it as a part of the consideration itself, which means current year amendment comes and clarifies that if at all you want an exemption under 10AA, deduction under 10AA, if you want a deduction under 10AA for the export turnover definition, it's not just consideration to be received in India, it is now consideration to be received in India within 6 months from the end of the financial year. It is consideration to be received in India within 6 months from the end of the financial year. This is what the next amendment is. This is what the next amendment is. But Rahul, consideration to be received in 6 months. What if I have got an RBI approval to do it 8 months? What if I've got an RBI approval to do it 8 months? Income taxes. In that case, if RBI is approving it, I will not question it. I will not question it. Third, I'm coming and saying, Rahul, why should I bring this money to India? What if I wanted to keep this money outside India only? What if I wanted to keep this money outside India only, but the money has come to me? See, understand, the money has come to me, but it has not come to my Indian bank account. It has come to my foreign bank account. Do you still have a problem? No. Income tax says it is not mandatory that I'm saying the word just because bringing it to India does not mean that you literally have to bring it into India. It means that you should now become the owner of the money. You should now become the owner of the money, which means even if you have got this money and you have kept it in your foreign bank account also, I'm okay with it. I'm okay with it as long as the bank is approved by RBI. As long as the bank is approved by RBI, which means what have I told? I've told that if you receive a consideration, the consideration should come to you within 6 months from the end of the financial year, or any extra period which RBI gives, or it should come to you in a foreign bank account which RBI approves. Any of the three happening, I will keep it as a part of export turnover. Otherwise, I will not allow it in an export turnover. Otherwise, I will not allow it in export turnover. Yes or no? Yes. Now, please understand this one thing very carefully, that Rahul, suppose for example, you have an export turnover. You have not bought it within 6 months and you have not taken it for export turnover definition. Will you also remove it from total turnover? Answer is no. Don't remove it from total turnover. In total turnover, the whole export turnover will be considered. It is your mistake that you did not get the money within 6 months. It is your mistake that you did not get the money within 6 months. You cannot remove it from denominator. You can only remove it from numerators. Yes. Read it once again with me carefully. Export turnover means a consideration which has been brought into India in convertible foreign exchange within 6 months from the end of the previous year, or such extended time as the competent authority may allow. Competent authority in India is no one else but RBI. Note, the consideration shall be deemed to be received in India if the export turnover is credited to a separate account which is maintained for that purpose with any bank outside India with the prior approval of RBI. If RBI is going to approve it, I am okay with it. If RBI is going to approve it, I am going to be okay with it. Yes or no? Yes or no? Please keep this in mind. This is an amendment in 10AA. This time default tax regime has become very famous, and therefore the expectation of this also being asked is very high. Is being very high, and therefore please keep in mind the 10AA definitions. Yes, you have no amendments in your AMT, and you have no amendments in your alternate agriculture income. Finally, in your unexplained income also, you have any exemptions? Yes. You have one small exemption which has come, which is the Agnipath scheme, which we discussed, right? If the income tax comes and clarifies in the new section called 1012C, where if a payment is made from an Agnipath corpus fund to a person enrolled under Agnipath scheme, then the person's income will become exempt from tax. Meaning, if a person has been withdrawing money from the Agnipath scheme, then in that case, whatever money he withdraws will be exempt from tax. Whether he does it or his nominees does it, it doesn't matter. Whether he does it or his nominees does it, it doesn't matter. The money will be exempt from tax. The money will be exempt from tax. And this fairly is your end of the chapters. This fairly is your end of the chapters. I am purposely holding one very, very critical amendment of the current year, which is your default tax regime. Part number 3 of this video, we'll do a detailed discussion on the default tax regime. So please bear with me for part number 3 and wait for it. Balance every amendments have already been discussed. Yes. If you by now itself realize the amendments in the current year are not significant, and therefore you don't have to worry about it. Some very small intricacies are there. If you keep in mind those intricacies, you are actually set for your May 24 as well, keeping in mind your November 23. So for all of my friends who are there a part of November 23, don't worry about the amendments per se. It is almost something which you can answer on your own in May 24 also. Take some time and go through these amendments once again in case you did not understand anything. If you still have some challenges, feel free to reach out to me so that we can discuss it once again. But please keep these amendments in mind. Some are very critical. They are very easy, but they may be the smaller things which you may miss out. So please keep those intact and you will be able to do better. Yes. Next video will be about a default tax regime. We will discuss about the default tax regime amendments very patiently and slowly, because that is one thing which is 100% coming in the current year. That is something which is 100% coming in the current year with the new syllabus coming and everything. Default tax regime has become extremely crucial for you. So we will discuss about the default tax regime in detail in the next part of the video. Until then, I'm signing off for today. I will see you guys very soon. Take care.